Thank you very much. Hello, everybody. How are you doing? Welcome to East Bay Regional Park District Board Finance Committee meeting. It's the 22nd and it's 12:32. So we're pretty much on time. Hello to everybody. And why don't we go ahead and talk about the openness of this and who's able to be here and listen. And if you could go ahead and tell us about that.
I'm happy to do that. So I will tell you this meeting is held pursuant to the Brown Act as amended by AB 361. Board members and staff may participate via phone and video conferencing. The Park District is providing live audio and live video streaming for this meeting. Members of the public wishing to make a public comment can do so in one of three ways. 1, live via the Zoom meeting. 2, by submitting an email to me at srice@ebparks.org. Or 3, by leaving a voicemail at 510-544-2400. And all of this information is noted on the agenda located at the Park District's website, ebparks.org. And if there are no questions about the meeting procedures, I'll go ahead and take roll.
Thank you very much. Any quick questions before we do roll? I'm sure we may have some questions later too. Yeah, go ahead, please take roll.
Okay, great. This is Shannon Rice, Recording Secretary, taking roll. Chair Corbett.
Here.
Director Mercurio.
Here.
Director Rosario.
Here.
Great, thank you. And would AGM Deborah Ocker like to introduce the Park District staff participating in this meeting?
Thank you, Shannon. Yes, I'm Deborah Ocker, the Assistant General Manager of Finance and Management Services. District staff today, we have Deborah Spalding, our Assistant Finance Officer, Christina Crosby, Assistant Finance Officer. We have Ren Bates from the ASD Design and Construction Department who will be presenting today. And then we have David Sumner, our Audit Manager, and a few other support staff. Thank you.
Okay, very good. Now, the first item we have on the agenda is the December 31st, 2022 investment report and portfolio review. If you could go ahead and start that presentation, Deborah.
All right, I'm Deborah Spalding, and I'm going to give an overview of the Q4 report. And then I'm going to turn it over to Sarah Walsh, who's here from PFM. And PFM is the Park District's investment advisory firm. They've been working with us for many years, and she's going to go into some more detail about the invested portfolio. So can you guys see my screen all right?
Yes.
All right. Good. So first, what I'm going to walk you through is a little bit more in depth. This is page 3 of your Finance Committee packet, which is a table that has lots of lines and numbers. And so I'm just breaking it down into chunks to walk you through it. So this is the district's entire cash and investment balances, not just the part that PFM invests, but everything. So first, we're looking at the liquidity portfolio. So these are the funds that are either they're currently cash or they're easily convertible to cash. And just a couple highlights that I'll bring to your attention here. One is that the December property tax receipts were received right at the end of the year, as they always are. So you'll notice this big jump in our market value of the liquidity portfolio from the end of September to the end of December. And that's because that's when our big chunk of property taxes are received. And if you compare where we were this year to last year, you can see that our property tax receipts were about 5.7 million higher than in the prior year. And just a reminder, because when you look at this, you think, gosh, it's a lot of cash to have on hand. So again, we just received this cash from the 2 counties. We draw on this throughout the next 4.5, 5 months until we receive that next big infusion of property tax revenues at the end of April. So moving on a little bit further down on the page of that page 3, now looking at the invested securities. So this is the portfolio that PFM manages for us. And Sarah's going to go in more detail about this. But a couple highlights for you. One is we decreased holdings in treasuries. We increased our exposure to corporate bonds, certificates of deposits, and agency mortgage-backed securities. And then another thing to bring to your attention is that we have been slowly increasing our the duration of the portfolio. And that's related to a decision that the Finance Committee made last year at this time to move from a 1 to 3 year duration to a 1 to 5 year duration. And the intent is to get us a little bit better return on that invested portfolio. So you'll notice this, I think Sarah will probably talk about it a little bit in her presentation as well. But you'll notice this, that we have more funds invested for the longer term securities. And then lastly, at the very bottom of that page 3, we look at our project bond funds and our debt funds. And the things to bring to your attention here, you can see we are slowly chipping away at all of these projects that the district is working on. So we're drawing down on those project bond funds. So if you look at the end of September 30th to compared to December 31st, a small decrease in the project bond funds available. And then you'll see the debt service funds had a big jump up in how much we have available for debt service. And that's because we receive our taxes that we use to pay off our debt service as part of the property tax payments. So that's another big chunk that comes in cyclically in December and April. So I'm going to now turn it over to Sarah. She'll do her presentation, then we'll take questions.
Hey, Deborah,
Yeah.
through the chair, if you would go back to that one slide, there are a couple of other things on there that I might point out. And that's because we have a few, we have our new board member, Director Mercurio. So when you look at our bond portfolio, every 4 or 5 years, we issue a new tranche of bonds, and we did that last February. So when you compare the December 31st of 22 to the 21, you can see there's more WW project funds also. That's because we issued additional bonds. So we issue bonds and then we draw it down as we do projects. So that's a big variance. And then as Deb mentioned, we receive the debt serviced funds. Also, the 26 million is greater than the 10 million, again, because we have a new layer of bond principal and interest to pay. So that number increased as well in 2022 as compared to before we issued those bonds in the prior year. So those are just also some of the why there's variances, which might be confusing. Thanks, Deb.
Excuse me, go ahead, Director Rosario.
Yeah, just a quick question. This is not germane to this report, but I just wanted to know, just remind me where our Measure AA funds, are those restricted to a particular sector, or can we use them district-wide?
They similar, but not exactly the same as Measure WW. They do have different areas where those funds are supposed to be used. And that has been a challenge now that we're at the very tail end of the Measure AA bond. So it started out with 125 million, if I remember correctly. And you can see we're down to the last 11.4 million. And they're in areas that are more difficult to find projects, acquisitions, or whatever. So this is something that we have been discussing.
Great.
Yep.
Thank you.
Is there anything in these numbers that we should be concerned about at all?
No.
No.
I just wanted to highlight some of the variances because we don't explain them as much in the report for the new members.
No, and I very much appreciate you bringing them.
Yeah, we have a little statement, and it's super small font at the bottom of page 3, where we verify that the amounts of cash and investments available are in conformity with the investment policy. So that's the main thing we're reporting on, and that we have sufficient liquidity to meet our expenditure requirements for the next 6 months. So those are the two things that we get into the details, but those are the two big picture items.
Okay, so it can smile for 6 months. Is that what you're saying?
Yes.
All right, very good. All right. Okay, thanks. We can go on. Any other questions from anyone? We can go on to the.
I did.
Okay.
Yes,
Director.
if I might. So I guess this would have been up on the first slide. at the, just kind of looking at the total cash investments held by district, the bold line there. I see a difference over time a little bit. How much of the change in the amount? So specifically, market value December 31st, 2021 versus a year later in 2022, it's roughly $10 million different. How much of that change, and this is just real in general, would be from earnings?
Not a lot. In this particular year, you can look down at the bottom. We have our investment earnings year to date. It's like 3/4 of the way down the page. I know this is very small font, but you can see our investment earnings year to date were about 1.1 million in this year in 2022.
Oh, I see. Yeah. Okay.
So not a lot of it's due to investment earnings. It was not a great year.
Yeah.
For, the investments for anybody.
Mhm.
And it can be more in depending on how the bond market is doing. But this past year, not a whole lot of that was related to investment earnings. It's more changes in how the district and PFM in particular is managing the Park District's portfolio. So they're making decisions day to day for us about how much to invest in different areas. And we'll have discussions with them about, more short-term or more long-term, depending on what they see how the market is headed.
Okay. Yeah, it does. I guess I was just hoping that there was some magic thing that happened and we did really well. But no, it's not. It's just the way things are, and we're doing the best we can. I understand.
Yeah, Director Mercurio, there is overall growth in the district as we grow. The property tax has been having growth, so that increases our fund balances. Our reserve policy is kind of based on the amount of revenue that we earn every year, so that grows and puts a little bit more in reserves each year as our overall revenue grows. And as Deborah said, the property tax for this year end was greater than the prior year by almost $6 million. So that's kind of in general, overall, just slow growth that the district has.
All right.
All right, I'm gonna turn it over to Sarah, and then at the end of this, we will like a recommendation to bring this to the board of directors. So I'll stop sharing.
Okay, very good.
Thank you. Just give me 1 second to go ahead and share my screen.
And nice to see you.
Hello, nice to meet everyone. Okay, can you guys see this?
Yes.
The customer, yes.
Okay. Well, thank you. Hello, everyone, again, and thanks for having me. I'm Sarah Walsh, Senior Analyst from PFM Asset Management. I know I've definitely met some of you before, but we've been working with East Bay Regional Park District since 2012 now as their investment advisor. And we currently manage about $200 million in assets in a fiduciary capacity. And just a little bit of background on PFM AM. We partner with public sector clients like the district all across the country with over $135 billion in fixed income assets as of last year and over 40 years of experience. Monique and Allison, whose names you'll see on the bottom of the page here, are the district's typical contacts at PFM, and I'm just filling in for them today as they're both away on vacation and hopefully enjoying themselves. So we'll start today with a brief market update and touch on some key points within the main investment portfolio, and then close with our typical environmental, social, and governance or ESG assessment. So let's get started. I'm sure you're all aware, and it's already been brought up today, that last year was quite the turbulent time for the overall economy. Particularly in the last quarter, we saw persistent, ongoing, higher than usual inflation and continued signs of an economic downturn on the horizon. Despite this, the labor market remained strong to close out the year. The unemployment rate continues to generally decrease, coming in at about 3.4% currently. So we're actually back and better than pre-pandemic levels there. And we're definitely seeing some mixed signals in the overall economy at the moment. The Federal Reserve has taken several actions to combat the high inflation and stabilize the economy. Their dual mandate is to both maximize employment and maintain price stability. We already talked about the employment component, which is doing quite well. So they're really taking action at this point to address inflation. And they've been raising interest rates in an attempt to reduce borrowing and spending by the consumer, thereby, cooling off demand for goods and services. And in theory, this will help to lower prices and bring down inflation. Now, inflation is a lagging indicator, so this will take some time before we see the impacts of this aggressive action from the Fed. The Fed funds target rate is currently 4.5 to 4.75% and is expected to be between 5 and 5.25% by the end of 2023. And I'll talk more about the Fed's actions on the next few pages here. But overall, the economy continued. The continued theme throughout the economy for the fourth quarter is high volatility. It was one of those kind of rare instances where both the stock market and the fixed income market both suffered kind of across the board. But as we move forward, the good news is that the volatility has begun to subside a bit. And so that's definitely a positive, and we're seeing some more stability within the markets in general. And we'll build on more of these kind of overarching concepts as we continue through the pages here. But just kind of remember to keep these overall themes and concepts in mind as we continue through the report. As I mentioned, an economic slowdown is expected. This page here really kind of captures what that means exactly. Generally speaking, we're expecting to face a quick and modest slowdown in the coming months and quarters. The gauge on the left takes into account kind of the different risks that we like to look at when considering the overall economy and how it's doing. And we've kind of placed where each of these factors falls on the spectrum that we created, with green meaning strong and red meaning weak or not so strong. Mm-hmm. The only one in green here is the labor market.
And for just a moment, I think we have a question.
I do have a question. I'm going to need a little more explanation as to what this is showing, especially why that arrow is there. What that's supposed to mean.
So, yeah, I agree. I did not make this chart, and it's I agree that it's not the best visual, but the arrow is essentially showing where we think the overall economy is at the moment. So if red's a recession, I would say we're kind of like right on the border of it. And all of these different indicators along the curve are showing like where they fall within the spectrum of, strongest to weakest. Does that make sense?
I have to think about that a little bit, but go ahead. I won't hold you guys up.
Yeah, sorry about that. Yeah, when I first saw this, I was a little confused myself, but hopefully once I talk through it, that'll make some more sense.
And in other words, I guess if you wanted to boil it down to like the real essentials, it's a good thing that arrow's not horizontal to the right,
Yes,
right?
that's exactly what the
Okay.
key takeaway is
So,
here.
in fact, based on my limited knowledge of the economy, that's kind of like where I would think it would be anyway. So
Mhm.
that's good. Thanks for the reassurance in a sense there. Okay. All right.
All right, so continuing on, yeah, feel free to interrupt if there are questions, by the way. With the way I'm sharing my screen, I can't see you, so just unmute yourselves and speak up, and I'll be happy to address any questions. So I think I was on the labor market, and as I said earlier, jobs are better than they were pre-pandemic. Jobless claims continue to decrease, and the unemployment rate remains stable. So that's why it's in green here. It's doing quite well. And then we have retail sales, which can kind of be moved, I guess, somewhere closer to the middle at this point of the gauge. And it kind of goes hand in hand with consumer spending. So I'll just lump them together and talk about them together. So consumer spending overall is starting to sputter to some extent. Credit card debt is going up and savings are going down. And the main reason for this decrease in consumer spending is the increased inflation, which remained at about 5% year over year for about 20 straight months now, which I'm sure we're all feeling. I know I'm feeling it. And so, why is this consumer spending important? It actually accounts for nearly 70% overall of the overall economy and is the largest contributor to GDP. So, a downshifting consumer is the key reason many believe that we're heading into a recession within the near future. Manufacturing is still contracting in the US as well, as demand remains subdued and production weakens. Housing sales are falling off now as prices of homes still remain quite elevated, and mortgage rates remain at about they start at about 6% these days. So it's just incredibly expensive to be purchasing a home right now. Another warning side is the inverted yield curve, which I'll explain kind of more what that means exactly going forward in this presentation today. But an inversion historically precedes a recession, and it has in the past. So kind of just taking all of these components together, we can move on to the right side of the page where we see the GDP forecast for the coming year or so. And the market is expecting pretty much no growth this quarter that we're currently in, followed by a quick and mild recession, and then a swift recovery into next year. And that is kind of in line with what the Fed is expecting as well.
Okay.
Here we show the yield curve where just shows like the rates that you would earn for Treasury securities at different maturities. And the left table shows the rates themselves, but I'll refer to the graph on the right since it's a little bit better of a visual and easier to speak to. So looking at the dotted line, we started off last year with a normal yield curve, so to speak, where longer securities earn higher rates and the investor is rewarded for taking more risk and locking their money away for longer. Rates were also near zero at the time, and due to all of the Fed rate cuts we saw in 2021. Flash forward to 2022, there were numerous rate hikes by the Fed as they took action in attempt to stabilize the economy. We see the entire yield curve shift upward, and as a result of the Fed's action. And here I'm looking at the lighter blue solid line for reference. The short end is much more sensitive to these rate hikes. So those rates increased at a higher pace, inverting the yield curve. Longer term rates remained lower as investors are cautious to go out that far amid the overall, uncertainty in the market, which is the thing that keeps coming up today. And then finally, looking at the darkest blue line here, we see the most recent quarter end. It's more inverted than it was in September. And despite the increase in the shortest area of the curve, the belly of the curve, kind of that 2 to 5 year space, rates actually decreased there. And I'm pointing this out because that's where many of the securities within the district's portfolio lie. So
Mhm.
just keep that decrease there in mind when we move on to the portfolio section today. And if we were to kind of refresh this graph and look at it today, we'd see even more of an inversion since the Fed raised rates earlier this month at their February 1st meeting. On this page here, we show the fixed income returns for various indices across different sectors in the 1 to 5 year space, which is where the portfolio lies. We saw positive performance during the quarter on the left, but that wasn't quite enough to offset the huge negative performance we saw throughout the year. The performance for 2022 was largely negative because of the raising rate environment. So as yields increase, the market value decreases, and that's what's causing the negative performance here. So it's the change in market value, which has a huge impact and is a huge driver of total return performance. Focusing on the left chart, just to highlight what happened during the quarter, corporates had the highest performance of the sectors analyzed here, and that proved to be a huge benefit in the district's portfolio, as 25% of your portfolio was allocated to corporates as of quarter end. They offered just great relative performance compared to treasuries. Relative value. Agencies and ABS weren't particularly attractive in general, but we were able to find value in certain issues during the quarter, which I'll expand on more once you get to the trade summary. But first, just to kind of wrap up our market update section, let's take a quick look at the Fed action this year and what's expected going forward. The dark blue shows the actual rate hikes that happened as of 12/31 when this chart was produced, while the light blue shows what the market was anticipating for the future as of 12/31 when this chart was made. So this is over a month stale at this point because of the reporting date here. And if we were to look at this graph refresh for today, we'd shade the first light blue bar darker since that rate hike did indeed occur earlier this month. And due to kind of Fed Chair Powell's more cautionary commentary, the market is now expecting 2 more rate hikes in 2023. So there would be an additional bar there, light blue bar there on the left. And no rate cuts are likely to occur until 2024. So that would kind of shift over to the right too. And tying this all back to your portfolio, this is good news. As an investor, we're going to be able to capture high yields as we're purchasing new securities, which means, higher interest earnings for you. And rates are actually at the highest point that they've been in about a decade and a half at this point. We're expecting the portfolio to continue to perform well as we move forward, both from an interest earned and performance perspective.
Sarah, are you referring to as far as high interest rates referring to the negotiable CDs?
Yes, all across the curve,
Okay.
but throughout various sectors.
Thank you.
Yeah. But that kind of concludes the market update section that I wanted to go through here with you today. So I'll just open the floor up again, see if there are any additional questions before we move on to the portfolio.
Should we have any concerns for what's going to be happening in the future?
Always.
The stance that we take, and I think that the market generally takes, is that a potential recession that's kind of the dark cloud over us right now. It'll be a quick storm and it won't be too bad. So it shouldn't really cause too much concern. And, you know, as the investor, you guys are going to be able to take advantage of those higher rates. So it's kind of a good story for you guys at this point.
Okay, thank you. Any other questions? Director Macrario, Director Rosario?
Regarding the CDs, as looks like we've increased it a little bit. Are we restricted by how long? If we buy into a CD, are we restricted to like 1 year, 2 year, 3 year?
Yes, I believe it's 365 days. Someone can correct me if I'm wrong, but I believe that's what it is. I don't have your investment policy up in front of me.
Let me pull it up. I'll get an answer by the end of the presentation.
Okay, thank you.
Thank you. Well, I do have your IPS up, but I'm sharing my screen, so I can't look at it. But any other questions before we move on here?
Anything else?
No,
All right.
other than that, I think this morning I heard that the Feds were going to vote to another 0.25%.
Mm-hmm. Yes, that is expected at their March meeting.
Okay.
Yeah,
thank
go.
you.
All right, so let's move on here to discuss the district's main investment portfolio with PFMAM. There are a few things I'd like to highlight here. The first is the portfolio's yield at cost or earnings rate, which continues to move higher. It increased by about 40 basis points during the quarter from 1.77% as of 9/30, which isn't shown here, I'm just referring to it, to 2.17% as of 12/31. And these higher earnings are due to the active management strategy that we have. And most of the new purchases had a yield above 4%, and in some cases, even north of 5%. The portfolio's duration was conservative compared to the benchmark. Its duration was 2.38 years, while the benchmark was 2.48. We strategically took this stance as the Fed continues to raise rates. We want to maintain a somewhat shorter portfolio to be able to take advantage of those higher rates available and mitigate our interest rate risk. And we can see this kind of cautious stance through the bottom right graph as well. The portfolio in blue holds more allocation to the shorter maturity baskets here and less in the 4 to 5 year space when, you know, compared to the benchmark in gray. Looking at that graph, you'll also note that we hold less in the 2 to 5 year space in general compared to the benchmark. And that's because rates aren't as attractive within that space right now, if you recall me touching on that during the market update section. Another key thing that I wanted to highlight here is the sector allocation in the top right. The portfolio is highly diversified. We were able to take advantage of higher yielding sectors and securities during the quarter because of this ability to diversify within the limits of the IPS. Looking on the bottom left graph, the portfolio is still, of course, fully investment grade. So these are all high quality securities that are held. So what changes did we make during the quarter? let's look at the net trade activity in each sector. So there were many opportunities throughout the quarter to further diversify the district's portfolio. We saw the most value in corporates, agencies, negotiable CDs, and asset-backed securities throughout the quarter. And that should kind of be no surprise since I highlighted these very concepts when we looked at the performance of each sector earlier today. To fund these purchases, as was pointed out earlier, sales and maturities of lower yielding treasury securities were largely used. But rest assured, almost 50% of the portfolio is still comprised of U.S. Treasuries, which is, of course, the safest and most liquid investments. And all purchased securities are also high credit quality. Is that a question?
Yeah, Sarah,
Rosario?
going back to the credit quality, I think I ask this every time, but just looking at our investments in the green that are not rated at 3%, are those, why are those not rated? I know I've asked this before, I just can't remember the answer.
Yeah, so those are not rated by S&P, but they would be rated by Moody's, for example, or Fitch. So this chart here is only referring to the S&P. So they could still be rated by other agencies and therefore allowed by the IPS.
Okay. And then why are we investing in something that's less than A? Like there's 2% in triple B.
Even though it is triple B plus, it is still considered investment grade. That's kind of the cutoff point.
Okay.
And I'm not sure if it's the case, but I can look into if that security was purchased when it might have been single A minus and then was downgraded since. That could very well be the case as well.
Okay.
That is my recollection. Is it, I think that's Lockheed. Does that ring a bell with you, Sarah?
Yes, it does actually. Thank you.
There's Goldman and Citigroup as well, or triple B plus.
And then just the overall prognostication of the economy. Is the environment considered at all? I mean, not environment, but I mean, just the like right now, the Midwest and the East Coast are going through will be going through extremely cold event in the next week, and that's got to affect a lot of farming food products.
Yeah.
So is there an algorithm that you guys use for some of these weather events that affect the economy that way?
Is that something PFM-AM does specifically? Yeah. No, not at this point, but I think that is still more broadly considered when making by the market when making projections for GDP. So obviously those extreme conditions like that are going to have an impact on production, on like maybe even consumer spending, all those different components. So that would impact the GDP going forward. Mm-hmm. But we do not I guess consider that, to answer your question.
Okay, thanks. It would be hard to do.
Yeah, I agree.
Thank you.
Okay, any other comments, Deborah Ocker?
Thank you, Director Corbett. I had a question on the next slide, Sarah. If you could just maybe explain to the committee the differences between the different agency categories you have there. These are agency securities, and then they have different acronyms next to them.
Yeah, so agency, CMBS, so and MBS pass-through, those kind of are very similar. So they have, so those are like MBS securities that an agency will release and issue, and then they kind of differ in the way that their payment structure is that their payment structure works, so how they pay the investor in the period that they do that. And agency CMEO are they all kind of like group together. We just separate them in this report, and those are all separate from the federal agencies, which are their direct obligations that they produce, similar to what the U.S. Treasury does. And I'm sorry, I know that wasn't the best explanation, and I can follow up with a better one if you would like me to do so.
What does MBS stand for?
Mortgage-backed securities.
That's
Ah, okay.
Yeah, so those are the mortgage-backed securities.
Yes.
That's all I wanted you to share.
Oh,
Thank
sorry.
Yeah, no, that's great.
I was thinking a little bit more detailed, and honestly, that's kind of outside of my day-to-day, so I wasn't quite sure how to answer that.
No problem.
Are those MBS? Are those MBSs mostly Fannie Mae and
Yes,
the other federal? Okay.
Freddie Mac. Yeah, that would be correct.
Great, thank you.
Mm-hmm.
Right.
Any other questions?
Don't see.
All right, so we left off here at the performance, correct?
Yeah.
So the portfolio had positive total performance for the quarter, and outperformed the benchmark. So the main driver for their outperformance was diversification, of course. And performance for the year is still negative given the sharp rise in rates during the first 3 quarters of 2022. When yields increase, price depreciation occurs, and that's why the change in market value on the second line there is large for that 1-year range. But looking at the interest earned for the 3-month and the 1-year time periods at that first line, we can see that the past quarter was responsible for about a third of the interest earned, despite being only a quarter of the year. And that's because the interest earned will continue to go up as the funds are reinvested in these higher yielding securities. For the past 10-year period, the portfolio has delivered a positive performance and is well ahead of the benchmark, looking all the way to the right here at that 0.91% versus the 0.96% annualized for the 10-year period. Looking at this from a different perspective, at the actual accrual basis earnings, the interest earned this quarter is more than last quarter, as higher yielding securities have been added to the portfolio, and we can expect earnings to continue to increase as those securities begin to pay off. The 10-year earnings rate for the district is about 14 million. And now that brings us to kind of the ESG overview for the portfolio. So we do manage the district's portfolio to an ESG or environmental, social, and governance mandate. ESG investing is simply another way to identify material risks within the portfolio, just through kind of a different lens. So we screen investments based on criteria that the district has picked themselves through collaboration and training with us. And incorporating ESG metrics into the investment process is simply another way for the district to keep their mission alive. So as a park district, you certainly keep these types of environmental or ESG issues near and dear, and evaluating your investments in this way is simply another way to align your portfolio with the district's overall mission. In this section, we dive into those detailed ESG-focused metrics. And just to note, ratings are not available for U.S. Treasuries or municipal obligations. So we're only going to be focusing on the credit portion of the portfolio here, which is about 51% of the portfolio. Another point I'd like to make is that although we provide metrics for agencies and supranational obligations, we only apply the screening metrics to the corporate portion of the portfolio. So those are the ABS or asset-backed securities, CDs, and corporate notes. We simply provide the info on agencies and supras because we have it available for reporting, but we don't limit those actual investments with the ESG criteria. So what is the criteria exactly, you might be wondering? I'll flip to the next page so that there's more of a visual to go along with the explanation. We utilize Sustainalytics data to determine these metrics, and Sustainalytics is a subsidiary of Morningstar, who you all might know. They're one of the biggest players in the ESG space here, one of the top providers. And they rate each issuer on a scale of 0 to 100, with the lower scale indicating a better ESG risk profile. They examine factors like water usage, pollution, employee retention, board independence, employee diversity, corporate bribery, and so on, just anything that could be considered ESG. And all of these factors are kind of combined into one all-encompassing risk metric, kind of similar to a credit rating, which analyzes through a credit perspective. This is a rating that analyzes the company through an ESG perspective. And that rating is known as the ESG risk rating. But before we get into the portfolio as of 12/31, let me just give a brief overview of the district's specific criteria. Investments are screened based on this ESG risk rating. Only corporate issuers with a score of medium or lower will be considered for investment, meaning they quantitatively have a score less than 30 on that scale of 0 to 100. However, there is an exception that a high-risk issuer can still be eligible if they're within the top 25th percentile of their sub-industry. So some sub-industries and industries tend to have higher risk simply inherent in their business structure and their operations. So I'm talking about automobile manufacturers or heavy machinery producers. Mm-hmm. So those businesses just, typically have higher environmental exposure, for example. And we don't want to rule out those issuers just because they have higher potential risk exposure, because they could be doing a lot to manage that risk, and what they're doing can be effective. So I'll flip to slide 19 to give an example of that here. On this page, we show the detailed holdings of the issuers within the portfolio. At the bottom here, you'll note Lockheed Martin has an ESG risk rating of 30.3, which falls within the high risk category. However, they also rank within the 24th percentile, meaning that they are performing better from an ESG perspective than 76% of their sub-industry peers. So since they're considered a top performer within their sub-industry, the issuer would then be eligible for investment, and in this case was purchased. Does that make sense? Mm-hmm. Okay, so let's just go back to the summary page. This is where we left off. So the portfolio ended the quarter with an overall ESG risk rating within the lower end of the medium risk range, coming in at 21.6 in green here in the middle of the page. Their overall risk exposure was medium, meaning that issuers had moderate exposure to the entire kind of realm of possible risks that are out there. And of these potential risks, many of them are being managed effectively by the companies through proper policies and procedures that they have put in place. On average, the issuers had strong management, looking at the bottom here. And that's reinforced again by their high credit rating and their mainly low to medium overall ESG risk rating. And that kind of concludes what I wanted to walk through with you all today. There are several additional pages here in this report for your own information and review, but I touched on most of the key concepts here in this summary section. So now I just want to pause and take a breath and see if there are any questions.
Thank you very much. Any questions, Director Rosario?
Yeah, not a question really, but just a comment. I think I'm happy to see the ESG component here. And I think Director Coffey and I, when we were both together, we had recommended something like this, and glad to see that it's ongoing and strong. And I just read a recent article where they were discussing that a lot of these companies with a good ESG score were actually companies that were also more sustainable. So I'm glad to see that, and I'm glad we're here. I appreciate the report.
Yeah, thank you for that.
Thanks, Dee. Nice comments. Any other questions? Director Mercurio?
Not right now, not yet.
Okay, very good. Next item. Thank you.
All right, thank you.
All right. Very nice to see you. Okay.
Thank you. Have a good day, everyone.
You
Thank
too.
you, Sarah.
Up for that weather.
So this is a recommendation item for the committee.
Right. Would anybody like to make the motion to support that?
So moved.
Okay, moved by Director Rosario and seconded by Director Mercurio. Please take a vote.
Shannon Rice, Recording Secretary, taking roll call vote. Director and Chair Corbett,
Aye.
Director Mercurio,
Aye.
and Director Rosario.
Aye.
Thank you.
Okay, passes unanimously by 3 votes. Thank you. Thanks for your good presentation as well. All right. So we'll go on to our next item, which is the job order contracting program and the quarterly report.
Good afternoon, Finance Committee members. I'm Ren Bates, Acting Chief of Design and Construction. Bear with me while I share my presentation here.
And I noticed that we have our new AGM of ASD, Ken Wysocki. Did I say that right, Ken? With us today.
Yes, you did. Yes,
Thank
you did.
you.
Sorry, I joined a little late. I was with somebody
No
else.
problem.
I presume folks can see my slides.
Yes.
Yes.
Thank you. Again, I'm Ren Bates, Acting Chief of Design. I'm here at the Finance Committee meeting. We find a way to sneak our projects into the Finance Committee meeting. So I'm here to give an update on our job order contracting program. So for this slide shows, I'll give an update on our current round of contracts, which are coming to a close. I'll remind the members of our next round of contracts, which actually came to our board, the board in January for the next round. So with that, I'll jump in. These tables are in your staff report. These show where we are with our current round of contracts. As a reminder, I should re-up. This is the first of the Finance Committee, so I should remind the new members of the Finance Committee that job order contracting is akin to on-call contracting. We put out a bid that is for fixed cost, fixed term, indeterminate quantity. What that means is that we have our consultant, the Gordian Group, puts together a construction task catalog for us, which reflects local material costs, local prevailing wage, and based on those cost numbers for various tasks that cover a wide range of tasks that we utilize here at the district, contractors bid an adjustment factor on that. And so what you're seeing here are based on those contracts that have a not to exceed amount for the current round of $1.5 million. These are the job orders that we've done and the costs that are incurred, or the cost that the job order costs, and then the 5% that we pay the Gordon Group is the consultant fee for that. The consultant fee for Gordon Group is 5% based on job orders, and that covers everything they do for the district. So that includes creating the construction task catalog, coordinating with contractors during the job order initiation process, and all of these things. So that cost is a pretty good value, in my opinion, based on how we've delivered and what we have for the amount of effort and cost that it would be to deliver with a design bid build process, which is how we do other project delivery. So what this slide shows is the projects that we've completed in this last round. As you can see, we've done quite a bit of work. This next slide shows that the projects that are still in construction under our current round. So when I said fixed term, these contracts are on an annual basis, and they begin when we give the first notice to proceed. And then from that date, it's a year long. So we then have a year to enter into any other job orders and or supplementals to existing job orders. So we have a few that are still open. I think we were about to term out on our last couple. So in other words, we have 8 contracts and they range in their terms. So they start whenever we give our first NTP, after we've agreed to the approved project costs from the project manager and the district's point of view. So these are the projects that we have going on that are in construction now and that will wrap up. So, and as a reminder, well, on the January 17th, the board authorized us to enter into agreement for the next 8 contracts in this next round of contracts. These include 3A licenses, which is general engineering, 3B, which is building contractors. So that'll be like HVAC, fencing, roofing, building systems, and then 2 general A, which is for paving. And you'll notice here that this year we've increased our maximum contracted value to $2 million. We found that we've been utilizing the job order contracting very well. And so this limit here is not the legal limit that the law and public contracting code allows us to reach, but this is a limit that we've set at the district. It's a comfortable level for staff to approach that we utilize. And so this has increased as we've done continued to do job order contracting with each round. So it may increase more, but this is where we are now. So these contracts are still being executed. They are being routed around. Once we have these fully executed, we will enter into, we'll have kickoff meetings with these contractors. We'll get them set up and we'll start the next round of job orders. So when I come back in 3 months, I will have a new update for you on where we are with these contracts. The next slides are some of that show representative work that we've completed on this round. Those of you might have heard this before, but I like to point this slide out is that the job order contracting allows us or has 2 values. So we have the contractor give us a value that on the tasks and the costs that are in the construction task catalog on regular hours. So that's like a Monday to Friday, 7:30 to 4:30, which are standard construction hours. And then they have an off hours. So based on, after hours work, which is shown here in this slide, we do some peer work, which is title. And so they have to work after hours. The job order contracting allows us to do that kind of work where we don't have to, where it's already set up. Basically, we can then do work as we need to in off hours, and it's easier for us to manage that as opposed to bidding and making sure that our work hours are a corollary. This allows us to do that, and it's one of the benefits of job order contracting, in my opinion. Here's another, what they've done here is they've completed the garage fire service for the mobile visitor center out of Shadow Cliffs. So it was installing all of this to make it compliant with fire. This would be sorry, to go back, this would be a B license, for instance. And if I went back further, this would be an A license. So this is sort of a general engineering, just to give you a flavor for the type of work that we do and the different licenses. So again, this would be a B. The other thing that allows, so this is a Dry Creek Dry Creek rock wall repairs that happened recently. This rock wall was washed out or had some problems from some flooding. Another benefit of job order contracting is that this has cultural value. And so we were able to work with our main contractor to find a sub that has the masonry skills to do the work as required by the cultural constraints that we had. So it's another way for us to deliver and sort of work to the final scope without having it all spelled out in the specs. It gives us some flexibility to hone in, review, see where we are, and then come to a final agreement on cost.
Questions, anyone?
So far.
Okay.
And then lastly, this is an example of the paving that we do. So that this shows that we've fixed some trails with our job order contracting. So overall, this is a brief update. I'm happy to field any questions. This is just an informational item. So if there are questions, I'm happy to field. I will stop my share.
Thank you.
I kind of breezed through that quickly. I realized I apologize for breezing through it super quick. I've done this and I forget that the committee members change. And so I don't mean to be short, but I'm here to answer questions. I can go back to any slides. Deborah.
Deborah?
Is that okay, Director Corbett? I just wanted to give a little more context, Ren. You're right. You come to the committee quarterly. That was an agreement that we made when we first started utilizing this procurement tool. So these are, as Ren said, publicly bid contracts. They just don't have to keep coming back to the board. They go to the board once per year. They get approved based on the lowest bid price. And then we have the ability to take our work plans and determine, is job order contracting the best way to get the work done if it's maintenance work. And so when you look at the list, you can see all these many projects that we're able to get done because of this procurement tool that we have available to us. And the way our work is determined is even ahead of the bidding of the contract. And you can see on here things like paving. So we already have our prioritization for paving that is done through MAST, through the pavement index, the PCI, pavement condition index. So that prioritizes which paving work should be done annually. Some of it's bid out separately. Some of it we use JOC for. And then also when we did our facility inventory, this is kind of for our new director as well. We did what we call our asset management inventory, and we assigned facility condition index ratings to all of our structures throughout the district. It was like 5 years of inventory and assessments. And we determined that replacing roofs and electrical were like the biggest bang for our buck to start with on these maintenance projects. You can see a lot of roofing projects on there, a lot of renovations as people move out of the district residences. The MAST team goes in and does work. Sometimes we have to contract for work. So that's kind of the balance between how the vendors get selected, the contractors get selected, and how the work is determined of what we're going to give to them. But great job, Ren. I love when you always bring us pictures of all the cool projects that were done, because in finance, we don't have a lot of pictures.
Sure. And I'll add to what Deborah said. I can share with you, here is currently our perspective list for this next round. So can you see this?
Mhm.
It's my perspectives. Oh, hold on.
You had it up correctly.
Oh, okay. Is it here?
Go back to that. Yes.
Okay, thank you. So these are projects that we've outlined and have as perspective. And to add to what Deborah said is that we do bid this. It's what we've found is that administratively, it takes us about 18 months to 2 years to run through it all. So they're annual contracts, but they're basically on a 2-year cycle. And this kind of highlights all of the current projects we have. What it also allows us to do is respond to emergencies as the case may be. And to reiterate what Deborah said, this is all for renovation, repair, reconstruction, remodeling kind of projects. We can't utilize it for any new projects, not any kind of design work that's done. We need to have our plans done. We bid this with our standard specifications. So basically all of our specs are included in when we bid this, but when we enter into each job order, we can then make different steps, be more clear on specifications, so we can amend as we enter into each job order. And so when there's specific needs for each job order, that is addressed in the process of the job order initiation, the site review, the final scope of work. All of these are steps in the process, and I'm happy to go into that, but it's less finance driven. The reason for this, as Deborah said, is that this is part of the agreement, and it was codified in our policy. The first rounds we did, it highlighted to staff that we needed to have a policy, and so the board adopted a policy, and then the general manager adopted procedures based on that, and those are what we comply with. So in the policy, it states that we need to come to the finance committee on a quarterly basis and provide an update on the projects as is. So, but as you can see, we already have a big amount of work queued up. A couple of these were spillovers from the last round because of permitting issues that sometimes don't line up with our project schedule. But that said, that's again, another flexibility of the job order contracting is that we can have it priced up and ready to go. So I will stop this share now. And thank you, Deborah, for elaborating. I am happy to answer more questions, but this is just informational, not a recommendation or anything along those lines. So.
Thank you. Are any of the ones on this list things that have been, well, I'm going to say there's a year here, any impact because of the current weather we've been having? Or anything?
There aren't any on the ones that are in construction. Potentially there will be some that we do and remedy with the existing or the ground we're trying to initiate. So, but those are still to be determined. Staff's still assessing a lot of the storm damage and how we're going to address that. So, but job order contracting is a method by which we can procure a contractor in a pretty fast fashion because we already have board approval and we have capacity to then move ahead with some of that. So it's a great option if it is decided.
Okay. And then on this Lake Chabot one, West Shore Trail landslide stabilization. Do you want to just explain why that's important, the stabilization part of it?
Are you looking, I'm sorry, Director Corbett, are you looking at the list in the staff report?
Yeah, it's a notice
Yeah.
to proceed.
The one that you had for us.
Yeah, it's
Okay,
number 5.
So your question is why it's important for the stabilization?
Mm-hmm.
Uh,
Why is it explained that way? Trail landslide stabilization.
That's the nature of the project. So there's a landslide that caused the trail to slough off, and so the project is to restore and stabilize that trail so it can be utilized by park users once again.
Yeah, and this is likely a landslide that happened a while ago.
Yes, that's correct.
Yeah, that seems to be something we never run out of.
No, it's not.
Just a follow-up question on that particular issue. I noticed that one's at 23,000. So typically we don't use JOC for projects under 50,000. Can you explain why we're letting this out on a JOC?
Sure, Director Rosario. That is true. Our policy states that we utilize this for projects that are valued at $50,000. There is a caveat to that, an exception that can be made for projects that are needed quickly, and that we have this contractor on board that can do that. So in other words, I think in terms of timeliness for response, some exceptions can be made. So I would presume that's the nature of this. I mean, that is why this one is that way, because somebody's already looked at it. We have a contractor that can do that work. Sometimes permitting delays us more than the contracting portion of it, so it doesn't get done as quickly, but that is one of the reasons why we have an exception to that $50,000 limit.
Okay. Yeah, I mean, typically it seems like our roads and trails, that's the kind of work they do. So, yeah, I'd like to hear more about the process on that particular one.
Sure, I'll have to dig in a little more and then I'll get back to you.
Thank you.
Me too, please. And me
Sure.
too.
Yep,
Okay.
understood.
All right.
Okay.
Any other questions? Yes, Director Mercurio.
Yeah, so this is interesting that this is all being presented now, because I just happened to have heard very recently about a long time HVAC failure at Black Diamond Mines, something dating back a very long time. Is this that number 4 there, Black Diamond Mines HVAC, is that to fully correct the HVAC system there?
I will have to check on that as well.
Okay.
I unfortunately don't have all the answers to all of these job orders. I'm overseeing the
Sure.
overall program, and so I don't have job specifics, but I can find out more. So I will find out more. I would presume as such that yes, that would be the case, because when we're addressing these, we'd like to do it whole. So in other
Yeah.
words, we're trying to approach like roofing for a whole park and sort of using it like that way, because it then allows us to bundle similar work and get all done in a park level. So I would presume as such, but I'll find out more and follow up with you.
Yeah, okay. The economy of scale, I understand that. That's good. It's a good way to approach it. All right. Thank you.
Sure.
Thank you. Director Rosario.
Yeah, just have one other question. I noticed that in the completed, it says number 4 has Delta Access, and then you have that same one on the notice to proceed in construction as number 8. And it's the same bridge. So did something else pop up or is this a continuation?
I think that's an administrative error, to be
Oh,
honest.
okay. Okay, great. So can you double check to make sure that wasn't
Yeah, I will. And you said
Okay,
that was
great.
number 4 on the complete
number
list?
4 on the completed, and then number 8 has the same
Yeah, I'll
number
double
8
check.
in construction. So
Yeah.
great, thank you. And then the irrigation repair project at Martinez, that sounds $600,000. That sounds more like a total renovation.
Yeah, it's a big project. So yes, it is very large. It's very large. It's a full complete redo.
Yeah, I would rename that a renovation versus
Yeah.
repair.
Yeah. Yeah.
Great. Okay, that's it. Thank you.
Sure.
It's obvious that JOC allows us a lot of flexibility and allows us to do a lot of projects to get done. So thank you.
Thank you.
Okay. Any other questions? Okay. All right.
Thanks, everyone.
Thank you very much, Mr. Bates. Thanks for the presentation. All right. That was information one, so there's no vote on that one for now. So we're going to look at the next item, which is disposal of fixed assets for 2022. Go ahead.
Okay, I'm going to share my screen. Let me get that. Okay, are we good?
We can see it. Yes.
Okay. All right. Good afternoon. Christina Crosby, Assistant Finance Officer. I'm presenting agenda item number 3 for the Finance Committee's review of the 2022 fixed assets, and I will be asking for a recommendation to the full board in March. So each year, as a little backstory, we do a physical inventory generally in October. Staff is given a few weeks, usually about 2 to 3 weeks, to turn around the results of the inventory to finance. And then finance updates all the numbers in our ERP system. And then we bring to the board everything to write off for over $25,000 if there's items. So this year we have 17 assets that were sold at auction. The auction is held by J.J. Kane Auctions in Dixon. And then we had about $87,000 in proceeds from those sales. We had 20 assets which were disposed or recycled, 1 asset that was donated, 1 was stolen. I believe that was a 12-person passenger van, and then 1 boat that was reported missing. So there is a full list of these items in your packet on page 83.
Did you say 1 boat that was missing?
That was missing. It
Oh.
was, yeah. And I believe it was older. It was already depreciated, and it was part of a fleet that had been replaced. So it
Where is it?
actually had no book value at the time. I'm going to check right now on the packet. And
Okay, and it disappeared.
yeah, hold on 1 second. Oops. I have the list up here. It was a Valco boat. I'm not sure what a Valco boat is necessarily. Let me
But it
see.
was, yeah, Christina Dora, it was purchased in 1987, so it was fully depreciated.
Yeah, it was significantly older.
This was on the top of the list here.
It's right in the middle of the page on page 83.
83.
There's just a boat one at the top.
Mhm.
Yeah.
Okay.
Okay.
Okay, so there's the whole list. And then the next couple slides, I'm going to go over some of the infrastructure that is being written off that we're recommending and the reasons why. So this first one here is the FEB trail improvement at MLK, which includes the construction of 2,300 linear feet of New Bay Trail. And to complete this project, we had to actually remove a boat launch and a dock. So since that asset now is gone, we need to take it off the books. So it's an administrative thing to get rid of what was there to make room for the new good stuff, right? So the next one is the Jensen House residence at Morgan Territory. It had been vacant for about 5 years, and that was due mainly to rodent infestation and black mold. So this was before, and now this is what it looks like now. So it's been removed, and there are no plans right now to replace that residence. The next one here is a residence at Vasco Caves Regional Preserve, which was also vacant for about 6 years due to deer mouse infestations and chimney issues. So this one was taken out and it was actually replaced with a new residence. So again, out with the old and with the new, and get the old one off the books. And then the last one that I have a picture of here is a maintenance office at Claremont Regional Preserve, which was leveled due to a failing septic system that could not be replaced. So this is the before, what it looked like, and then we have it all cleared out. And they're considering, you know, potentially a staging area here or something like that in the future. A couple of things that I don't have any pictures for, but are definitely worth mentioning on the list, is the Sunol Visitor Center's exhibits that were infested with rodent droppings and deemed a health hazard. Those are being removed from the list. And then we had in 2021, it was reported that a water treatment plant at Del Val Regional Park was disposed. A hypochlorite system used with the water treatment plant to disinfect the water using a sodium solution was removed in 2022. So that hypochlorite system is on the list to be removed as well. And we had a bathhouse and pool deck that were listed as one asset in relation to Robert's pool renovation. So taking that off the list. And that really is the presentation. Staff is asking for a recommendation to the full board for the 9 items that were over $25,000. And with that, we can answer any questions that you may have.
Okay, thank you. Members, do any of you want to get some of those things back that we gave away? Just kidding. Thank you. Looks like there was some really great decisions made to deal with our lovely park areas and take care of our lovely employees as well.
Yeah.
Director Rosario.
Do we get any, I think it's great that we're donating equipment, especially public safety. I know we've donated a fire truck and a couple times, and I'm glad that everything's getting used. Is there a tax benefit for us when we don't make those donations?
Deborah, did you
No.
want to?
Yeah, there's not a tax benefit to us. The tax benefits are usually when corporations make donations and are paying out separate types of taxes. We don't pay those taxes, and we don't get any benefit of sales tax, which we do pay for sales tax, but there's no tax relief for donating on sales tax.
Too bad. And then just a question on the van that was stolen. Was that ever recovered?
I do not know if they found it or not. I do know it was a very old, I think it was like from 2001. So it was fully depreciated, and it was at Crown Beach. And I don't know if they found it. Might be somewhere.
So it was at Palm Beach in the back parking lot there?
Yeah.
It just disappeared one day.
Yeah, I think the gate actually had been opened and they did see that the gate had been breached, and then they discovered which one was gone.
Okay, thank you.
Cool. I think that's
You know,
it.
I do have a question. I always have this question. When the information is given to people to let them know that these items are for sale, how do we advertise it? How well are people able to get a hold of that information to determine items they might want to purchase?
Christina, do you have that?
I do know it's at the Dixon, the JJ Kane auction site, which they have an outward facing website. So anyone really could go and purchase, and then it goes to the highest bidder. So it's all open to anyone who wants to bid on them.
And that's
I
true.
think there's people who routinely look for these things, and they know where to go to look. And all we need to, the beauty of that outfit is we just plug our stuff in there, and then they tell the world about it, and that's a good way to get rid of it, because there's I mean, sometimes it's a good way to get something that you couldn't afford otherwise. So yeah.
And do we see this as one of the more obvious spots to let people know about these items?
Yeah, I believe it's a pretty standard practice
Okay.
for these types of items. And I think pretty much the first 17 items on that list went to that auction site. And we did see a return. I mean, our net book value on those were 0. And so we were able to recoup $87,000 off those items when we sold them.
Yeah. Some of them look like they were sold for a pretty good price in the length of time that they have. All right. I'm just looking at the rest of this. And items recycled. Ah, that's nice. Toastmaster recycled. All right, Deborah.
Thanks, Director Corbett. I just wanted to say this is one little piece of many processes here at the Park District. So today we're asking you to approve these disposals, but as Christina mentioned, some of these things have been replaced, and we have a separate process where we capitalize new assets. So every year we go through the list of everything that we've purchased, anything that's new, anything that's in construction and progress, and we record those new items into our capital asset records. So that's a separate process. And then I also wanted to mention, if items are stolen or missing, those are always reported to our risk department. And if there is insurance available on any assets that are damaged or stolen, then we recover that through our insurance with our risk department.
Good. On these assets that are recycled, tell me a little bit more about that. They just put them out there for people to pick up?
I'm not sure if we have a service, but certainly those are at the end of their useful life as well. It looks like a lot of them may have been through our concessionaires or some of the Ventec pay stations. So I'm not exactly sure if we have a recycler that we send it to, but we can look into that.
Yeah, I'd like to know. Thank you very much. Any other comments or questions on this item? Yes.
Yeah, and this one, I don't really expect an answer right now to this because it's a slightly off the immediate target that we're looking at right now. But I'm just wondering about all the assets that the district have, which are considerable. If there is some kind of management program, management software that tells us when maintenance needs to be done on them. Any and all assets.
We have, it's separated into a few categories that I can speak to. I'm not sure every asset is logged, but as I mentioned earlier, we went through a complete 5 to 6 year inventory of our structures. So buildings, structures, utility systems, bridges, things like that were all assessed, and they do have a maintenance plan, and they have a rating, facility condition rating, as well as our paving. And then when it comes to vehicles, our fleet manager has a complete inventory of all of our rolling stock and our major equipment. And so those are on a schedule, on a replacement schedule that he reviews annually to determine whether, if it's scheduled, doesn't mean it really has to be gotten rid of, but, they have their assessment that they do. And then small tools and other types of equipment, I'm not exactly up to date on what our practices are for that.
Simple painting. Do they get scheduled, or is it just when somebody says, oh man, that's rusting, we better do it? Or is there really a schedule for looking at things? And just
no, that's I don't think painting is included in the facility condition index, but certainly if we're going in and doing any other work, we add that to it. That's a great question for the MAST department that we can get back to you on.
Yeah, I hate to see things rusted, and I know that once something gets rusted, the work to restore it is a lot more, it's a lot of labor. So that would be one thing that I'd be concerned about is, we ought to know anything that needs something made out of steel, maybe. We shouldn't let it start rusting through. We should be painting it more often. I mean, it just seems like that's how you take care of an asset, at the highest, to the highest degree.
And I think we do that in many cases. I've heard of that.
Yeah, it's possible. I know.
Yeah. Christina, do you have any examples you want to share on that?
I don't have any examples of rusting steel.
Yeah, we can check with park operations and MAST and get a little more details on that. We'll send you an email.
Yeah.
I think the park supervisors manage those types of items in their parks.
All right. Any other comments or questions? Okay. Oh, we have a hand up. We have someone speaking.
Public comment.
Any other comments from the board members? And if not, we'll go to the public comment.
No, yeah.
No other questions? Okay. All right. Can our staff person allow the visitor to speak?
Yeah, Kelly, you can go ahead. You have 3 minutes.
Okay, thank you. Well, as a fan of the Navy, if you look out in San Francisco Bay, all the Navy ships and all the regular ships, every big ship you see out there, they only last about 40 years. And the main reason for that is that they rust. The Air Force can keep their airplanes flying forever, but not the Navy. Navy, things rust. If you take a step back and kind of look at the overall state of the budget of this district, let's start with the head count. It was 630 in 2010, 890 in 2019, and 1,000 in 2023. The growth rate, compound annual growth rate on that from through 2019 was 4% almost. And after 2019 till now, 3%. So that's a pretty healthy 3 or 4% growth rate, close to 4%. The population growth, what's the benchmark on that? Well, as a finance person, you'd say, well, we're trying to serve these people in our 2 counties. What was the population growth in the 2 counties over the last decade or so? Just over 1%. So you are outstripping the population growth. Your employee headcount is outstripping the population growth by a factor of 3 or 4. Then you say, well, you know, what about our labor costs in the budget, in the finance? That's 2/3 of our district expenses. And but we're not relying on the population. We're relying on the property taxes. And how are we doing on property taxes right now? Well, if you look at property values in the last year or so in these 2 counties, they're down about, what, 9% for home prices? 9% drop, and about 10% of that happened a month or 2 or 3 ago. It was a big drop right there. So anyway, the annual drop was about 9%, and that's 2/3 of your revenue has just gone off a cliff. So it's okay, because this is a backward looking lagging indicator, right? You're not gonna feel this for a year or 2, about a year and a half. But when this does start to kick in, and it'll only kick in slowly and gradually, I'm not sure that this district can really keep boosting up the headcount by 3 or 4% per year. And maybe the good times, you know, of growing government headcounts and payrolls, maybe those good times will have to be cut back a little bit. Thanks.
Thank you very much. Any other public comments? Okay. Any questions, or would anybody like to make the motion?
So moved.
All right. Director Rosario is making a motion for the list of fixed asset disposals to be
Second.
recommended to the board of directors, and seconded by Director Mercurio. All right, please call the roll.
Shannon Wrights, recording secretary, taking roll call vote. Chair Corbett,
Aye.
Director Mercurio,
Aye.
Director Rosario.
Aye.
Thank you.
Thank you very much, Shannon, and that's a proposal supported. Moved on to the board. All right, any other questions or comments on that one? It doesn't look like it. So our next item is public comments. Does it look like we have any public comments at this time period? Shannon?
I'm not seeing any, and we have not received any.
Okay, all right. Then the next item on the agenda is committee comments. Committee members, any comments? Director Rosario?
No, I just want, I really appreciate how the finance department is so meticulous. And I think it goes well to, speaks well to the health of the park district as well. I mean, when I was a park supervisor, I used to brag that we could follow every dime that was spent in the park, and it's still true. Just to kind of rebuttal to the public comment, the park district has been understaffed for many years, and I think COVID has brought that to a head, and that we need more people to make sure that our parks stay open. And to also, on a public comment that Mr. Abreu made at the board session, staff equals reliability. So there we go. So yes, we won't. There will come a time when we'll have to look at our hiring more people, but that's well into the future. So thank you.
Thank you, Director Rosario. Director Mercurio.
Well, just thank you for all the good work from a whole team there, all working together to make this as clear as it possibly can be. And that's something, you know. I didn't have that many questions, so it's thanks a lot. And I'm looking forward to learning a lot more about all this going forward. And also, I guess I'll piggyback on Director Rosario's comment there that you can really oversimplify things. That's kind of the national pastime politically, is to oversimplify things and you know, excoriate somebody because you're just looking for simplistic explanations that aren't adequate to fit the real, you know. Just for one example, that the comparing against population has no relation to how many acres we're adding in a given year and how much more maintenance we have to do, or assets that we're creating that require, you know, maintenance and attention. So anyway, couldn't let that one go.
Thank you, Director. And happy celebration of today to you as well. All
Thank
right.
you.
Any other comments, questions? Anything else you'd like to say, Ms. Alker?
No, thank you so much, directors. Great meeting. Thanks to staff.
Okay, in that case, the meeting is adjourned. Congratulations, everyone. Thank you for
All right.
all your great help.
Thank you, everyone.
See you next time.
Have a